Silver didn't rise. It broke its own rules. For 40 years, this market obeyed gravity. Prices moved, corrected, reverted. Professionals built careers on that rhythm. But between January 2024 and January 2026, silver didn't surge the way commodities usually do. It moved from $23 to over $117 and kept going without the usual blow-off chaos. That's the contradiction. Explosive price action without speculative panic. And if you think this only matters to traders, it doesn't. This reaches straight into energy costs, technology supply chains, and the value of the money you use every day. Here's the detail most people miss. The quoted price says one thing. The price to actually acquire metal says something else entirely. Premiums jumped from $3 to $15 over spot. Not gradually, rapidly, quietly. That gap is the story. But here's the part nobody is saying out loud. Markets only behave calmly like this when something underneath is failing. What looks like a rally may be a repricing. And once you see why that distinction matters, the rest of this story becomes unavoidable. At the surface, this story looks simple. Silver prices went up, but that framing hides more than it reveals. What's actually happening is not centered on price at all. It's centered on availability. The official market still quotes silver through futures contracts, largely priced on exchanges like the Comex. Those contracts trade at volumes roughly 50 times larger than the amount of metal that ever changes hands physically. For decades, that imbalance didn't matter because delivery was rare and trust was intact. Now notice what's changed. The cost to acquire real metal has detached from the quoted price. Premiums didn't rise by 10 or 20%. They jumped 400% from $3 to $15 over spot, even as the base price itself tripled. That tells you the stress isn't in speculation. It's in supply. This isn't an isolated event either. It fits a broader pattern where paper markets function smoothly right up until they don't. When leverage replaces inventory, price discovery becomes theoretical. Here's why that detail changes everything. If the price is real, but the product isn't available, which one do you trust? The strongest claim in this entire story is also the easiest to verify. The paper-silver market is no longer anchored to physical reality. The evidence isn't abstract. It's visible in inventory data. Comex eligible silver fell from 290 million ounces in January 2024 to 147 million ounces by December 2025. That's a 50% decline in 2 years. More critical is registered inventory. The metal actually available for delivery. That figure sits at just 124 million ounces, covering barely 28% of total holdings. Now put that next to futures open interest. Paper claims exceed deliverable supply by roughly 4 to 1. That leverage only works if almost nobody asks for metal. But here's the concrete shift. Premiums are exploding while prices rise steadily without the volatility spikes you'd expect from speculative mania. That's not traders gambling. That's buyers securing supply. Notice what's missing from this market. No volume blow-off, no retail frenzy, no parabolic collapse, just steady upward pressure and shrinking stockpiles. This is where the story flips. When even a small percentage of contract holders demand delivery instead of cash, the exchange faces a problem it cannot hedge. As this pressure builds, the system doesn't snap all at once. It tightens. And the first place you see that tightening isn't on charts. It's in behavior. By January 2026, major bullion dealers in North America quietly changed the rules. Pre-sales disappeared, purchase limits appeared, shipping timelines stretched from days to 6 or 8 weeks. These aren't customer service issues, they're liquidity signals. Here's why that matters. Dealers only restrict sales when replacement inventory becomes uncertain or unprofitable. Selling metal you can't replace is how businesses fail, so they stop. That's the same psychology that drives a bank run. The moment trust in future access breaks, everyone moves at once. Notice what they didn't deny. Dealers didn't say demand cooled. They didn't say supply was improving. Instead, premiums became a kind of ransom, the price of certainty in a market where certainty is disappearing. This is where normalization becomes dangerous. Extended delays and limited access are being treated as routine, even though they signal a breakdown in just-in-time supply. Now watch how fast this escalates. When sellers start behaving like long-term holders, the entire pricing model shifts. Up to this point, you could argue this is still an investor story, but this is where that argument collapses. The strongest pressure on silver right now isn't coming from traders at all. It's coming from industry. In 2025 alone, solar panel manufacturing consumed 173 million ounces of silver. That demand wasn't optional. It was locked in by government mandates and corporate build-outs already underway. And projections for 2026 point higher, not lower. Add another layer. 5G infrastructure consumes roughly 40 million ounces annually. Data centers, electric vehicles, advanced electronics, all of them require silver for efficiency. And unlike consumer demand, this demand does not disappear when prices rise. These buyers don't speculate, they allocate. Here's the contradiction that changes how you see this market. There is no viable substitute at scale. Manufacturers already thrifted silver loads to the physical limit. Go further and performance fails. That forces a behavioral shift. Industrial buyers stop sourcing just in time and start stockpiling. Notice what's missing again. There's no elasticity, no demand destruction. This is the moment silver stops acting like a commodity and starts behaving like infrastructure. When demand becomes inelastic, inventories become everything. And that's where the vulnerability turns systemic. The paper market only functions because very few contracts ever ask for metal. But available inventories are being drained at a pace that breaks that assumption. Comex saw 31 million ounces leave its vaults in just 3 months. That's not rotation, that's withdrawal. The London market tells the same story. LBMA vault holdings fell from roughly 1.2 billion ounces to 900 million over the same period. And this isn't trading metal moving around. Much of it is held for institutions and sovereign entities, which means it's being removed from circulation. Here's the part nobody wants to say clearly. If even a modest share of futures holders decides cash settlement is unacceptable, the exchange does not have enough metal. The mechanism fails. This is where trust becomes binary. Either delivery works or the paper price collapses into irrelevance. Rule changes, forced cash settlements, margin hikes, those are not solutions, they're admissions. This is the moment where a pricing system becomes a confidence test. Now the pressure starts stacking fast. First, government debt crosses $36 trillion, with some estimates pushing it toward $40 trillion. The interest bill alone tops $1.2 trillion a year. That's more than defense spending. Second, interest rates sit structurally above economic growth, which means the debt cannot shrink. It compounds. Third, the only release valve left is monetary expansion. Here's the mechanical consequence. More borrowing is required just to service old borrowing. That forces central banks to absorb issuance, which dilutes the currency. The market isn't guessing anymore, it's adjusting. Notice how silver responds. Its rise to $117 isn't framed as a trade. It's treated as insurance. Institutional capital isn't chasing upside. It's fleeing a denominator that's losing credibility. This is where the story accelerates. As bonds stop functioning as safe assets, money has fewer exits. Stocks fall with bonds. Cash erodes in real time. Physical assets absorb the pressure. So ask the only question that matters now. What happens if this continues? This is where it stops being abstract and starts landing on you. Not investors, not institutions, you. When silver becomes harder to source, it doesn't stay in vaults. It moves straight into the cost structure of daily life. Solar gets more expensive. Electronics take longer to ship. Infrastructure projects miss timelines. Those delays don't show up as headlines. They show up as higher bills and fewer choices. Think about how this feels in real time. Products go out of stock without explanation. Prices don't just rise, they gap. Replacement parts take weeks instead of days. That's not inflation psychology, that's scarcity friction. Here's the quiet shift. When industrial buyers start hoarding to guarantee continuity, retail buyers are pushed to the back of the line. Availability becomes allocation, and allocation always favors size and urgency. Notice how familiar this feels? We've seen this movie with energy, with semiconductors, with housing. It never announces itself as a crisis at first, it just tightens. If this feels familiar, say so in the comments, because the question isn't whether this affects daily life. It's how long before it becomes unavoidable. To understand why this keeps happening, you have to step back from silver itself and look at the system around it. Modern markets don't prioritize resilience. They prioritize efficiency. Leverage replaces inventory, speed replaces redundancy, and trust replaces verification. As long as nothing breaks, this looks brilliant. But here's the mechanism that turns stress into crisis. When incentives reward paper claims more than physical control, scarcity gets hidden. Prices stay calm while fragility builds underneath. Then one variable changes: delivery risk, political dysfunction, data uncertainty, and the entire structure reacts at once. This is why silver matters more than it seems. It sits at the intersection of industry, money, and trust. It's small enough to break, but essential enough that it can't be ignored. When stress hits, there's no committee meeting. Capital moves mechanically toward assets with no counterparty risk. Here's the unsettling insight. This isn't mismanagement, it's design. Systems optimized for stability collapse suddenly, not gradually. And once confidence shifts, it doesn't return quietly, it migrates. From here, the path splits, but neither route leads back to normal. One path assumes containment. Exchanges manage delivery through rule changes. Cash settlement becomes more aggressive. Prices stay quoted, but access keeps tightening. On the surface, stability returns. Underneath, confidence erodes quietly as participants learn the price is informational, not actionable. The second path is faster. A catalyst hits. It doesn't have to be dramatic. A yield spike, a data blackout, a prolonged government shutdown. Something small that removes the assumption of control. In that scenario, delivery demand rises just enough to expose the imbalance. The paper market doesn't explode. It hollows out. Notice the asymmetry. There's no mechanism to quickly increase supply. Mines can't ramp. Substitutes don't exist. Inventories are already thin. That means time works against containment. This is where momentum replaces debate. Capital moves preemptively, not because collapse is certain, but because waiting becomes expensive. The next move hasn't happened yet, but positioning suggests it's forming. And once it starts, it won't ask for permission. There's one insight that ties this entire story together. Price didn't fail first. Trust did. The silver market is simply where that loss of trust became visible. For decades, promises worked because delivery was rarely tested. But once availability matters more than quotation, the system reveals what it's really built on. Reframe everything you've heard through that lens. This isn't about silver becoming scarce overnight. It's about paper claims becoming optional. When that happens, markets don't crash immediately. They invert. The real price migrates away from the screen and into private transactions, premiums, and refusal to sell. Here's the line that matters. A market can survive high prices. It cannot survive disbelief. What comes next isn't a chart pattern. It's a behavior shift from traders to holders, from exposure to possession, from confidence in systems to confidence in things. If you want to understand where this goes next, because this isn't isolated and it doesn't end here, follow the channel. The next layer of this story is already forming, and once it's obvious, it will be too late to analyze calmly.